We ended 2025 with about 98% of our transactions settling in under 60 minutes.
What is required to make that work?
That can only happen with a pure focus on automation.
In your worldview, what can't people copy?
If I had to summarize it down to 3 points, I would say number one is
presented by Stablecon Media, powered by BVNK. Views are personal, not investment advice.
This is Money Code. It's a show where we decode stablecoins and programmable money. I'm Chuk, Okpalugo.
And I'm Raj Parekh, and today we're joined by Prabhakar Reddy, co-founder and CEO of OpenFX. Prabhakar, welcome to the show, and let's jump in. OpenFX has had a pretty awesome story and scaled from 4 billion to 45 billion in annualized TPV in 2025. What was the biggest unlock for you all, and what does that reveal about what's actually broken in cross-border FX?
fantastic. First of all, thank you for having me. Lovely to see you both over here. 2025 was a fantastic year for us. First thing, we came out of stealth midway through the year. We were operating in stealth for the first 18 months of our operation. What clearly unlocked the growth for us in the first 18 months and mostly through 2025 were three different things. One is, I would say, focus on our core ICP. We did not try to build everything for everyone in this space. It is quite a wide space in the inter-cross-border payment space. We decided to focus on a specific ICP, which is seed to Series C fintech companies, and service them really well. Rather than trying to be everything for everyone, we tried to be something for just those people, which is allow them to convert currency A to currency B and withdraw that in under 60 minutes, any time of the day, any time of the week. That really has resonated with them. So that's one. Second thing is a fundamental focus on automation. Rather than like this entire industry currently operates on chat, WhatsApp, Telegram, phone calls, even some of the old school FX players. We said, nope, that's not our ICP. If anyone wants to even pay 5% per trade because they're going to do a phone call and execute a $50 million trade with us, we're like, go to our customers, you better service there. We are pure programmatic API-driven platform. What we are trying to build is a platform for other platforms to build on, and which means that everything from deposit taking to sort of collections to banking to FX conversion to payouts, everything needs to be automated. That's the only way we'll bring the time for cross-border money movement down. We started off 2024 roughly at about 6 hours of settlement time. We ended 2025 with about 98% of our transactions settling in under 60 minutes. All FX currencies, stablecoins, whatever that may be, right? And that is a phenomenal start, and that can only happen with a pure focus on automation. So that's been the second primary thing. And the third thing is a little bit cliche, but I will still say it because it actually has been one of the core things and a core focus for the company, which is the team. Without this team, who actually comes from a varied background of understanding stablecoins, FX, compliance, licensing, regulation, how to operate a 24/7, 365 business, it cannot come together in such a short time span. Because if you look at other companies, take TransferWise as an example, they've been around for 16 years, roughly. They do about 25, we do about 25% of their volume, and we're only a 2-year-old company. They have 6,500 employees. They're roughly like 75. So there's a big delta in terms of how we operate as a team and how we are an N of one team that allows us to do what we do.
Oh, that's awesome. And would love to kind of break those things down as we get on here. The specific focus on the customers and the types of products that you serve. Then the automation, I think that's a key piece to unpack. And then the team as well. But as we break all that down, I really want to get into today, what are the kind of the non-obvious constraints in FX that you have understood and have been proven to be true as you've scaled. And then we'll walk through a transaction end to end through OpenFX just to understand exactly how everything's pieced together and the automation that you mentioned, and then discuss like what makes you differentiated. And then as you scale, what breaks, and what all this means really for the future of FX. So before all that, can you just describe OpenFX to folks who don't know? Who are the buyers? You mentioned the C to Series D fintechs. What job are they hiring you for, and what part of their stack are you replacing?
Fantastic question. So OpenFX started with one mission vision. And that's been the core focus today for a long time and will continue to be, which is to make sure that money across borders moves 24/7, 365 in single-digit minutes eventually, almost like how an SMS or text moves rather than how a postal era post moves today, which is how money moves around the world. Like you put a post in the post box, somebody comes, collects it at the evenings, goes to central post office, goes to post box A, B, C, D, and eventually reaches your home 5 days later, which is exactly how cross-border transactions move. Instead, we're trying to build the iOS iMessage ecosystem where money can move, whether it's a $100,000 transaction or a 10 million peso transaction near instantly across border. So that's what we do. Who's our core focus as a client base? Other fintech companies, and that's who we started with today, right? Why? Because, like I said, can we build everything for everyone? No. We go after the legacy fintech companies. We go after large hotel chains. They have all these ERP integration requirements, large sales cycles. Do not want to go after that. But the customer base who faces the pain point most acutely are other fintech companies. And having been a former VC, I've heard so many pitches, all the fintech companies coming to me and saying, I need to raise my series A, B, C, D, all for working capital. It's not like the fintech companies have huge OPEX needs. It's all pure CapEx needs. And for them, they want to make sure that they're pre-funding their assets in country A, country B, bank A, bank B, C, so that they can actually sort of mimic payments in real time for various different companies. And this happens across the globe for whether it's remittance company, payment gateway, or travel platform. Every single one is repeating the same infrastructure again and again. We realized rather than every single platform trying to do this, can we seamlessly integrate all of this and sort of solve that problem for them? Could we have done this 5-7 years ago? Very unlikely. Few things have happened in the last few years. Number one, stablecoins have found PMF. So what that allows us to do is, without showing anything to the users, right? Without letting the users know about the underlying tech, we're able to move money from country A, convert it into whatever currency you want, bypass Swift layer if you need to, and move it to country B in single-digit minutes, and give it to the customer on the local RTP rails. Again, 5 to 7 years ago, most of the local sort of last-mile emerging countries did not have RTP rails. Now we are in like the second, third generation of RTP rails in most of these countries, whether it's Mexico, Brazil, Europe, India, Philippines. And so we're able to sort of like move money across borders seamlessly, programmatically, and give that experience to our clients, right? And what's happening is they're able to take our platform, compete with their legacy fintech competitors, and sort of eat their lunch. They're able to slash their costs. They're able to give them real-time experience for their clients without having to have really large balance sheets like the predecessors and compete with them. So that's basically how we've been able to crack this market segment in a very short span of time. This we started with. Now, interestingly, in the last 6 to 9 months, ever since we've come out of stealth, all the legacy fintech companies have started reaching out to us. And they're like, hey, what's going on in the space? These new kids on the block, some new remittance player, which has started, I don't know, from UK or from Mexico, is eating our lunch left, right, and center. And when we dug up, we heard that OpenFX is powering them. Help us understand what's going on. What is this stablecoin? What is this Solana? What is this blockchain? We're like, hold on. You don't need to understand all of these things. It's the same infrastructure that you're used to using, Currency Cloud, Airwallex, whatever, Citibank infrastructure. It's very same. It's the same thing. Plug OpenFX's API into it, give us your asset A, convert it to asset B, and click withdraw, and you get it. You don't need to understand wallets. You don't need to understand stablecoins. You don't need to understand anything about blockchain. And that literally blows their mind because it's like a 2-hour integration for them.
That's right. And I think the key thing you mentioned there that was interesting for folks is the capital element. The fact that for startups and fintechs, working capital is a key constraint that stops them from scaling, and you have to go and raise capital at a very expensive cost, right? The cost of capital is very, very high, especially for a startup, in order for them to grow. And so it's a great use of the capital, but if there's a way for them to scale quickly globally without that balanced need, then you're giving them fuel essentially, and that improves the ROI of scaling a fintech, particularly cross-border fintech, massively. You mentioned then the new customer segment, the more traditional fintechs. If you can, what's the breakdown of the kind of the $45 billion across, the different segments that you have? Understanding that obviously you started with the original fintech, so obviously they've had more time to scale.
Good question. So I would say it's almost 70-30 at this point, where 70% is still the fintech segment. Interestingly, the companies that were seed Series A when we started have now grown to Series B, C, D already using OpenFX as a platform. So they've seen hypergrowth. They've become billion-dollar companies using our infrastructure. So now, would you still call them AB companies? Perhaps not. And so they've become their own legacy fintech companies and of sorts for certain regions. But the newer players, And we categorize them into two segments: companies that started before 2020 and the ones that start after 2020. Right? The ones that started before 2020 are almost like the legacy fintech players. Some are publicly listed companies, some are old school players. They've started adopting and leaning into stablecoin narrative a lot more. They're like, we understand that we have to get into this. If not, it's going to get troublesome. And we're like, great, we want you convert anything into stablecoins, that's great. If you don't need to, we'll just give fiat A to fiat B. Again, seamless programmatic experience, and that blows their mind. And that's how we've seen adoption in that segment.
That's awesome. And how does it split also across corridors? I think we haven't talked about the many countries that you support and the different currencies that you support, both fiat and crypto. It will be helpful to understand that as well.
So it's been about 20 months since we've gone live. We're live in about 12 currencies so far. 10 odd are in GA and 2 are in beta stage. We've been going live with one currency a quarter previously, and now we've accelerated that to one currency every 6 months. Eventually, now we're, with the onset of AI, our ability to sort of integrate with local banks, providers, liquidity providers, slicing, all the infrastructure is in place. We're ready to bring down what used to take 2 months down to about 4 days now in terms of the entire integration timeline. So we're able to move much faster. So we should be launching almost one currency every 4 to 6 weeks. Now, out of those 12 currencies, I would say it takes us about 6 months to go from zero to maybe like $250 million to $300 million of TPV per currency. And that's when we're like, okay, this currency is in a very stable place and it's post-GA. And so we basically have launched bulk of our currencies in the last 5 to 6 months. So all the newer currencies are still in that zero, I would say like $50 to $50 million range. But the ones that actually were launched in the early part of 2025, AED, for example, MXN, Euro, GBP, dollars, they are through the roof. Like, we have entered those markets and sort of dominated those regions. And interestingly, even the new currencies that we're launching these days, I'll give you an example, PHP. We just announced that we're going live with PHP in the market, and all the existing players sort of like changed their entire pricing strategy, knowing that OpenFX is entering the market, slash their rates by like 50-60%, just to stay competitive, because that's been our entry model. What we do is we enter a domain, we slash the pricing and bring it down to like such bare minimum. It's almost the Amazon business strategy, where we are saying, you know what, FX is a market where people charge 70, 80 basis points for everything. Instead, we make markets ourselves. We are market makers by DNA, having built FalconX, having come from a lot of these institutional platforms. We're able to bring our cost structure down to like single-digit pips. Why don't we charge that to clients and give that kind of a cost structure to them? So what that allows us to do is competitively enter a market while bringing down the settlement time. And so that's been our playbook.
Yeah, this is fascinating. I guess one quick question is that you mentioned the combination of both fiat and stablecoins. Like, how do you see that interplaying within the core infrastructure today? And like, you also mentioned that, hey, you don't really need to know what stablecoins or blockchains are. So I guess, like, are you providing fiat services, but then is it powered by stablecoins, or are you actually seeing demand from your customer base to say, we actually do want stablecoins also? Just curious how it all interplays together.
Yeah. So if you look at our website, we don't talk about stablecoins much or have the word stablecoins anywhere, because again, clients don't care about the tech, they care about the outcome, and we pitch the outcomes and the benefits. Now, we look at stablecoins as yet another currency. If you want euro, pound, dollar, MXN, BRL, whatever it is, we'll give it to you. You also want USDC, USDT, happy to give that to you. That's how we see it. Do clients want stablecoins? Yes. There are a couple of clients who want it, specifically because we don't do the end-to-end corridor ourselves. For example, we are not live in India as a region. And it's coming soon. We're working on it. We need to get the local infrastructure licenses, all of that set up. So we only do half a leg for remittance companies who go, from dollars to INR or pounds to INR. And so we basically go from pounds to dollars to stablecoins, give them the stablecoin, they take that, go to whatever they need to in the last mile region, collect the local currency there. But we know that if we can give that last mile currency, sandwich the entire thing, we remove the stablecoin piece completely from this.
Yeah, no, that makes sense. And then I guess, like, what type, you mentioned like these are fintech use cases. Like, maybe describe just like the types of use cases. Are these, you mentioned remittances as one of them, but like what are the types of use cases are you seeing? Is it predominantly B2B? Are these consumer use cases? Like, what are these fintechs actually doing with the OpenFX platform?
Great question. So predominantly it's remittance companies, payment gateways, payment processors, payroll companies, neobanks, brokerages. These are the 6 segments. Now, there are some enterprises too, and niche enterprises. Like, for example, I told you UAE is a very large corridor for us. In UAE, very interesting use cases. And I say this because I grew up in Dubai, it's home, and I understand everything that's going on in this country a lot better. We've got one client segment which basically services the oil and gas sector and the shipping industry. Fascinating industry because I've got a port right next to my house over here in Dubai, and I see how much they pay every hour for having a ship sort of like dock at this port. Very interesting use case where before OpenFX, they would basically come pay lots and lots of fees every single hour to basically have the ship at the port to be inspected. After the inspection is done for, I don't know, let's just say bananas or whatever it is, right? They wait about 12 hours for the inspection to get done. Once the inspection is done, they wire the money. They wire the AED to, let's just say, the Philippines, if the ship came from there, or to Guatemala if it came from LATAM, and it takes 3 to 5 days for the money to reach the vendor. 3 to 5 days that ship is waiting at the port, paying hourly $5,000 an hour shipping docking fees, right? And those bananas are rotting in the meanwhile. Now come OpenFX, we basically are saying, you know what, just give us the AED and whatever currency on the other side, we pay it out in 1 hour to that last mile current. Now that's a fascinating use case. They're able to empty the ship, clear the dock, and the next ship is, the world is getting more productive as a result of money moving faster, cheaper, better, right? Now, yes, we've used stablecoins in between, but neither the vendor knows, nor the receiver knows. It just all happened magically because we've gone from AED dollars to stablecoin. The stablecoin is moved from UAE to LATAM, or from back into dollars into that last mile currency, given out to whoever it needs to get out. Fascinating use case. No one needs to understand stablecoins. That's what's happening.
Yeah, I mean it's fascinating because I think sometimes people over rotate towards stablecoins, and what you're presenting is like, hey, this is just a innovation and infrastructure on money movement. We can make these things a lot simpler and faster, and as a byproduct of that, the supply chain is actually getting faster as well. Which is actually, if you compound that over to like the global supply chain and global trade, it starts to get really fascinating, and we've only scratched the surface of it too, which is really kind of cool. Maybe like I'm curious, like you mentioned that it takes about 6 months to really see a currency go up, and what I think even it'd be interesting to break that down, because in the beginning you're talking about you got to do the integrations with like the local rails. And then you get to get the liquidity going as well. But maybe if you can break down, like you have another currency that's going to go live in 4 to 6 weeks now, but maybe what are the different pieces, and where do you guys and how do you guys try to pick the demand for the currency? Is it all customer driven? Are you trying to stay a step ahead because you know what's about to come? Like, curious how you guys are making that decision.
Great, very good question. Let's start with the second part of the question. How do we pick currencies? I don't wake up every Monday morning and go, let's go here. That's not how it works. We actually survey all our customers every month, asking them, because these are all fintech companies that are growing very rapidly. We ask them, what currency can we unlock for you that if we gave it to you at an extremely competitive rate and very fast settlement times, that your business will rapidly scale? And you're already doing, not like some hypothetical currency that eventually you wish will come for you. And so we basically stack rank, and we have an active list for our customers, their currencies and volume, and we haircut that by a little bit and be like, okay, now we know what exactly is the roadmap of all the currencies we need to launch. And then we have an index of how complex the regulatory regime is, how much, the local banks, infrastructure. We've surveyed most of these regions. Do they have APIs? Do they have local liquidity partners? How easy or complex is it for money to move out of the ecosystem? Are stablecoins allowed, or are they banned in that region? So we take all of that into account and then basically pick the regions that we need to go into. And once we pick the region, a lot of things that need to happen. One, we need to basically usually have a local presence, right? Because we want to have last mile. We don't do swift wires into that country. We do that, then we are yet another provider that has existed for 20 years. That's not what we do. So we need to have a local banking infrastructure, local liquidity providers, local OTC desk integration, local market integrations. Why? Because that's slicing and dicing and smarter routing is one part of how we get the liquidity. But then we also make our own markets. So usually what happens is our trading desks, and we're like, maybe just digressing for 30 seconds. We're like Citadel Securities that sits underneath Robinhood. So we are both at the end of the day, because we're building our own marketing infrastructure. So for that currency, our trading team sits and starts making markets and starts going deeper and deeper in terms of reducing cost structure, right? And then we'll combine all of this and try to make it go programmatic. The biggest challenge in this entire piece is banking ecosystem. Most of these banks in these countries don't have APIs. they say they have APIs, maybe they have it in some regional language which is not translated into English. How things are broken, we fix, errors for them, and we basically create our infrastructure. And a lot of times when they don't have APIs, we actually create RPA systems, robotic process automation systems, where we have an ops guy who'll go and like click, 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 show what needs to be done, and the RPA system repeats. So because we need to get the deposit instructions scraped and put into our system. We need to ensure that every time money comes in, it's credited accurately. Then when there's an FX transaction, the money goes out to whoever it needs to go out. So that needs to be, and when the last mile money needs to go, that also needs to be paid out. All of this programmatically via APIs. When the bank doesn't have APIs, means there's a lot of automation that needs to go. All of these boxes are checked, then, and that usually happens when we've gone from zero to like $200-300 million in volume and done all of these things. Then it goes into GA, and that usually has historically taken us 6 months, but the time is shrinking faster and faster because now we're out there in terms of our brand and everything else, so people know, and we're able to see that pickup in curve instead of 6 months in 5 months, and 5 will eventually become 4 to 3.
Yeah, that's fascinating. I think we talk about automation and AI a lot, but what that means in practice is taking a lot of these steps that are human required with clicks and browser automation and things like that, and turning those into processes. And when there are no actual APIs, it can be quite brittle, I'm sure, as you've seen. But over time, you catch edge cases, you improve, and like you mentioned, maybe it takes 200 million of volume to have seen sufficient edge cases where you now feel comfortable making it automated. An underlying system that itself really isn't.
That's right. And if you go back to what we were discussing originally, the reason the world operates this way in 5 to 7 day settlement times is because one part of it is tech. Yes, a lot of these last mile countries don't have the tech and the integrations, but a lot of it is also like misaligned incentives. A lot of the banks, and all banks, are not in the business of moving money, they're in the business of keeping money. Right, so they want to keep money and sit on the float for as long as they can because that's how they make money, right? And the entire intermediary banking infrastructure that has operated in the world for the last 50-70 years, where you send dollars from US to say India, INR in India, it goes through 5 to 6 intermediary banks in between. It goes from Wells Fargo to Bank of America to Citibank to JP Morgan, and finally goes to Axis Bank in India. And every single bank has a different time zone, different operating hours. Everyone wakes up in the morning, a lot of manual processes, and then they want to sit on the float for the entire day if they can because they're making them interest. All these misaligned incentives, basically make money move slower along with the technological problems. Now, if you automate this entire thing, remove all the intermediaries in between, make it fully programmatic, suddenly the world starts getting more efficient. And that's the unique thing that we're doing. It's not rocket science, right? But just removing all these friction points in between and making sure that the next generation of tech companies that are building on top have access to these kind of rails.
That's great. That was one of the questions that we had for you, just to break down what is wrong with the current infrastructure and landscape today. And I think most people know or understand the correspondent banking problem. And like you mentioned, the incentives that are key to it at the beginning, where, depending on how many steps there are, each one is taking the cut, each one is holding it just overnight, just to earn that additional spread. And, that's a key thing. And I think there's still a bit of misconception with what part Swift plays in that it's actually a messaging layer. It's not actually the one doing the movement. But outside of kind of correspondent banking, there's a lot of fintechs. I think you mentioned them. Some of them are your customers who have tried to solve this with balance sheet and netting. But there are still problems for that perspective. Maybe you could just describe, for the fintechs who are trying to solve the correspondent banking system, what problems do they still have in cross-border payments?
A very good question. And in fact, before starting OpenFX, I just went into a deep research mode. I actually said, let me understand this space very deeply. I know Bill FalconX before, so I understand crypto space quite deeply. But I was like, this world of FX is fascinating. Let me just unpack it layer by layer. So spent time from the founders of Currency Cloud to the FX desks at Barclays. Spent deep amount of time sitting in their offices, in fact, a couple of times, to understand how they move money. Where is it getting stuck? What are the incentives? And it was a fascinating experience as you peel every layer of the onion to understand what's going on. So let's start with the market structure. Every day, about $7 trillion moves around the world in FX, of which $2 trillion is spot, $5 trillion is options, derivative swaps, right? Of those $2 trillion, a good chunk of it moves through 9 different banks around the world. JP Morgan, Citi, HSBC, it's very concentrated, right? And now if you look at the next layer of fintechs that all started in the last say 15 years, companies that start between 2010 to 2020. They're all multi-billion-dollar fintech companies that basically said, I'm going to take all these 9 banks, create API wrappers, and give access to the next level of tech companies. So they're all built as wrappers around these large banks, effectively. They're not trying to reinvent the wheel. They're saying, I'll just take a Barclays API, I'll give a programmatic experience to them, and I'll charge a nice margin on top of that, and give them access to collection, banking, FX payouts. Great. Now, the fundamental problem is Barclays is not in the business of rapid money movement, right? Barclays doesn't work after 4 p.m. ST. Not picking on Barclays specifically, but every different bank in the world, right? They don't work on weekends, they don't work on national holidays. And then you compound that with 5 different banks in between, and the problem gets really compounded, right? And every single one wants to sit on the money for as long as they can. And then you add different compliance rules, different manual processes, and suddenly the problem really compounds. And that's literally the way the industry is working today. Now, every single fintech that has ever operated in the space historically is connected to some infrastructure that was built using this infrastructure. So we said, if I try to build another application on top to solve this using a wrapper on Barclays DBS HSBC, nothing is going to change. In fact, I may sort of simplify the product experience. I may remove some of the onboarding fees, some slashed down the costs a little bit. But this is trying to basically pick from a very small pool and trying to create incrementally better experience than trying to build for a platform and ecosystem that is going to be in 10 years' time. I have a slightly different view on where the world is going to be in 10, 20 years' time. We decided, you know what? This is not the way to do this. If I have to fundamentally reinvent the entire way this is going to work and what it's going to look like in 10 years' time, we have to start at the crux of the problem. The crux of the problem is not in collections. The crux of the problem is not in banking. It's in liquidity and it's in FX. And we have to solve that at that grassroots level in every region, right? And we have to solve for the last mile liquidity. Now, in the last 5 years, what has happened is crypto exchanges have popped up, right? And so as a result, Bitso, Coins.ph, CoinMina, etc., Kraken, all of these have a little bit of liquidity where you can convert stablecoins to some level of FX. And a lot of these new age remittance companies, new age cross-border companies, all the TechCrunch news articles that you see got built and got started using crypto exchanges. So it was a great start for them. Now, the problem is crypto exchanges are built for shitcoins and Bitcoin and everything else, and stablecoins to FX have some liquidity, and you can get started on it. You can do a very good $100,000 size order, or maybe our 100,000 euro order, but you try to do a 10 million euro order and you have 5% slippage. And suddenly it's better off to send money using Western Union than to use, one of these crypto exchanges. So there are very few use cases where it makes sense to use a crypto exchange to pay 5% to do it rather than, and wait, rather than to wait 5 days to use MoneyGram. So we decided, what crypto exchanges also won't work because, again, we used to make markets on crypto exchanges in my previous avatar. So I know why I would or why I wouldn't make markets there. So we decided, let's basically go back to the drawing board and let's start figuring out if this is getting rebuilt, how would it get rebuilt? We need to make markets in every region. We need to plug into all the local vendors, local OTCs, local market makers, and have a predictive ledger as well. And this is one of the learnings that we took from TransferWise. TransferWise is one company that has done something innovative in the last 15 years, if anything, where they give a near instant money movement experience where they collect money from pocket A but pay out from pocket B. But what they do behind the scenes is pre-fund their assets in all the regions 2 or 3 days in advance. And they've done a fantastic job of it, right? Now, can every company have that size of a balance sheet and sort of pre-fund everywhere? No. So what we are saying is, can we basically take some of those learnings, give access to all of the people? So we actually have our own predictive ledger, right? Of the $50 billion that we move, we know historically now it's Friday, 7 p.m. in Dubai for me. I know at 8 p.m., I know at 9 p.m., I know at 10 p.m. Across all currencies, what kind of flow I'm with 80th percentile accuracy that I'm going to expect. I see 80th percentile because we have new customers joining every week, doing new things, and suddenly those models break, which is a good thing and a bad thing. So now what that allows us to do is make markets and hold positions ourselves. So we do that as well, right? In addition to slicing and dicing and smart routing and all the other infrastructure that's in place. So combining all of these things, we're able to sort of upend the historical way the money has been moved in the past few years and sort of like get to a place where we're able to programmatically move money using, again, stablecoins, FX currencies, programmatic infrastructure or APIs to give that wonderful experience to our clients.
That's awesome. And I'd love to get into that. I think throughout this conversation, you've picked on various different parts of the stack. Let's walk through a $10 million transaction. I think it's a well-known thing that, yes, crypto exchanges don't necessarily have the liquidity for the very large B2B payments that need to occur instantly. And they're very, very good for small resale payments. And that's how, as you said, many startups have gone off the ground. let's take the example you shared earlier, $10 million worth of AED to the Philippines. Where does it fit into the system? What is stablecoin? When is it on-ramped? When is it touched by OpenFX and so on?
Good question. So $10 million is a decent size to talk about because you try to execute that on exchanges and suddenly things break, right? You're not able to do, not even just one side, both sides you do and everything breaks. So without OpenFX, what typically happens? Let's talk about that. Let's just say it's a remittance company. They will collect the AED. They'll usually use a regional bank. They will convert those AED, that AED to PHP will cost them 50, 60 basis points, and they will initiate the wire to go to Philippines. Usually it takes 2-3 days. It's Friday, so the bank's already closed right now. Maybe Saturday, Sunday, nothing's going to happen. So Monday they'll initiate the wire. On Wednesday they'll reach. So what usually the remittance company has historically done is they've already pre-funded their bank account in Philippines with PHP and kept it saying, hey, I already know that $30 million of PHP is required every day. I'll keep $32 million maybe worth of PHP over there. If I've gone above that, back to Swift Rails, I can't service my customers. I'm going to make them unhappy. That's how historically it's worked. But in the last few years, with the onset of crypto exchanges, some of the newer players had said, you know what? Let me basically execute part of these trades on a coin Mina in UAE, convert that to stablecoins, move those stablecoins to Philippines, convert that on coins.ph back into PHP, do it. Now, you can do $1 million, $2-3 million worth of trades on either side. Fantastic. But you try to do that programmatically every single day for double-digit, triple-digit $1 million, and suddenly the exchanges don't have the liquidity because they're not, again, in the business of creating FX depth. They're in the business of allowing you to buy Bitcoin, Ethereum, all the other altcoins that you need to. Now, with OpenFX, what we do is we make markets in both these regions ourselves, deep FX markets. So we're able to sort of programmatically receive that AED locally into our account. It's usually near instant because local AED rails are fast. So we get the money into AED. We convert that AED into USD. We make the markets for it. So it usually costs, very few pips to do that. Once we've gone from AED to USD, we convert that into a multitude of stablecoins. Which stablecoin really, we don't pick whatever is the cheapest, fastest, most liquid stablecoin at that point with the best incentives. Our algorithms will pick that. Take that stablecoin, push that to our Philippines, for example. And in Philippines, off from that back to dollars, right? And dollars to PHP, again, we make the markets. So we've gone from AED in UAE to PHP in Philippines, usually in under 10 minutes. Why 10 minutes? Depending on what chain, what stablecoin we used, the number of chain confirmations is usually where it takes 10 minutes. Otherwise, it can happen in a second. So once we've gone there, PHP local rails are 24/7 again. We pay it out to our customer into their local bank account in Philippines, and they're able to pay whichever customers they need to. And that's how can happen, whether it's a Friday, Saturday, Sunday, no banking cutoff hours, nothing.
So that's a fantastic and great way to really lay that out loud. What is required to make that work? So you mentioned it. Some of it is you need real-time rails on either side. Then you need to have APIs, or you mentioned robotic process automation on either side. Then you need to make markets on either side with deep liquidity. And obviously from FalconX, you have experience there. But you need capital to make those markets on both sides. So there's capital involved as well. And then obviously wallet infrastructure in order to manage the stablecoins. Maybe I've missed some things there. Could you just talk about what is needed for that operation?
You unpacked a lot of them, but there are a few more things. One, first of all, in every region, you need to have local presence, to have a local account, local bank infrastructure, local licenses. You can't get away with that. You're touching fiat assets. These are not on-chain shitcoins that you can say it's DeFi. I don't know how to touch it. It's fiat. So you need to have local licenses and regulations. It usually takes time to get that set up. It requires capital as well. So you start from there. You need all the local KYC compliance infrastructure and comply with those rules. So that's one. Number two, you need to have a very deep understanding of FX markets and ability to make markets here. Because one thing you realize after being in the space, there's no such thing as an interbank rate or a mid-market rate. It's literally whatever these days. You can you'll have to make your own markets. You have to figure out what the pricing oracle is. You have to build out that infrastructure. So having a tech team and an FX team and a markets team that actually understands all of this and can do real-time 24/7 work is a second part of it. Third, a very deep understanding of crypto and stablecoins, because that market infrastructure is very different from the FX market infrastructure. So understanding that. Then the fourth thing effectively is the ability to do all of this programmatically. So an extremely, jacked up engineering team, which can basically get all of this done Whether they're APIs, they're not APIs, doesn't matter. Making sure that that entire leg is automated. And number 5 ultimately is the business model itself, right? Your ability to basically do all of this using a balance sheet, a very large balance sheet that can almost pay for itself because balance sheet is not free, right? You're running a very low margin business, but you're running profitably. So doing it at scale and doing it in a way that you don't basically get one hit and wiped out is another thing. And the 6th most important thing is, while doing all of this and moving billions of dollars, doing it in a secure manner. Because one step of the way, one fat fingering mistake, one weak link, and everything is gone. Because ultimately you're moving money, you're not shipping burgers and pizza. So people have to be very secure and safe about this. So all of these 6 things, doing it while running a 24/7 365 business is hard. And I didn't start OpenFX with the intent of actually starting this company. I think I told you this when I met here. I was looking at companies, any founders who were trying to build this space, and I said, you know what, I'll lead your Series A myself if you're doing a fantastic job. Realized nobody wanted to build this business. It's a very complex business to build. And anyone who would go into this business was like, I'm doing so many things. I want to charge 82 basis points to 100 basis points, and because I deserve it. I'm a premium product. Then suddenly you're back to the world that we're currently living. I said, no, okay, it requires somebody who actually deeply understands all of these things and can build it in a way that the world should be. I want to basically create a world where money actually doesn't cost so much to move. So sort of bending reality to my own will and solving it for myself, if anything.
Yeah, I mean, it's a great explanation, and I think it's a good segue into, I think some of the next topic around differentiation. And just, I think oftentimes in the stablecoin space, we see a lot of orchestration companies, or they call themselves, on and off ramp aggregators. You see a lot of these terms pop up, right? But what you're describing is you're talking about depth in terms of infrastructure building, in terms of liquidity, in terms of actually building out that infrastructure and doing it in a certain way. Maybe like in your worldview, like describe just like, what you think is, maybe what can't people copy, right? I mean, a lot of the stuff you talk about, it sounds easy when you say it, but when you actually do it, it's actually a very different thing. And then also, I think the most important part that you touched on is the business model itself. Like building a low margin business, it takes a balance sheet, and it takes a lot more, and there's actually a lot more involved. Maybe if you can describe just, taking a step back of like, what the market looks like today, what you guys are providing that's differentiated. And you touched on some of these parts already. And then maybe like we can go into like the liquidity flywheel and the business model here itself. Like you guys are able to provide and go and take this Amazon approach and go into these markets and slash prices, but also do it effectively as well. Maybe if you can just like unpack all that together for us.
There's a lot to unpack here, and we'll go on for another 45 minutes if we do that. So let's touch upon some of these things. Look, there are lots and lots of players in this entire equation, and a lot, especially in this day and age, with how good lot code, cursor, everything has gotten. You can wipe code pretty much anything. What is very hard to wipe code is building regional liquidity in each of the places and sort of building that stack in a way that you can actually make money and giving access to customers so that they can actually sort of utilize all of this. Because software layer will definitely get vibe coded out in the next 10 years. And we actually thought about it very deeply. All the orchestration there, just collecting money from point A and paying it out to point B in 100 different orders. It's not hard. That's not rocket science. I appreciate the companies that are doing it, and that's fantastic. But all of that can be vibe coded out by a 14-year-old kid in 5 years' time. But building all of these things with the licensing stack, with a programmatic ability to do all of it is hard. So if you talk about differentiation, touched upon a lot of these things, but if I had to summarize it down to 3 points, I would say number 1 is having that full end-to-end automation is a big differentiating factor. In fact, if you talk to our customers, one of the reasons they use us is because they don't have to talk to us. Which is, it's weird, but it's also a great thing, because we're like, yo, if you want to talk to us and have chat and be nice, we don't have a trade operations team, a trading desk who sits and chats with you on Telegram, WhatsApp. That's not how we operate, right? That doesn't scale, because if you want to get to $1 trillion a day of volume, we cannot do that manually by throwing people. I'm not trying to build a Bank of America here with 10,000 employees. We have 300 people at most at peak, and all of that is going to be primarily engineering. Right? So that focus on automation is a key differentiator for us. Second thing I would say is our ability to operate 24/7 is also a key differentiator. Our ability to provide pricing for FX on weekends, but no one does it. Like, in fact, We went to some of the largest banks in the world and we were saying, hey, we want to basically get access to your banking infrastructure so that we can run it. When they learn what we do, they're like, wait, you make markets on weekends? We don't have access. And they are like 500-year-old banks that actually don't have access to this infrastructure. They're like, can we use you guys for weekend effects and we'll give you access to our banking infrastructure? So that's where the conversations are, and not even like the fintech companies. For fintech companies, they want to operate 24/7. Even the legacy banks don't know this is feasible. Third thing I would say that differentiates all of this is the underlying business model. And we talked about this briefly, right? Fundamentally, rather than trying to build a business that, let's just say the next competitor in the space of ours would charge 50 basis points. If I charge 45, Chuk will go start a company tomorrow and charge 40, and Raj will charge 35, and it eventually becomes a dog-eat-dog business. It's like, if it's going to become a dog business, let me induce a race to the bottom and operate it at a margin that the next player, if they want to compete with OpenFX, has to bleed $100 to $200 million of cash just to basically get into this business. So very low incremental margins left on the table, which is the Amazon strategy. If I tell either of you guys to go start an Amazon tomorrow, we're like, fuck this shit. It's not worth it. So same thing. So we are trying to build that underlying AWS infrastructure that every other fintech can build on top of with such low margins, but at scale, we'll actually be a very profitable company because I don't need to charge so much, because in every stack of the way, I'll make a few basis points, but by charging so low and making the money moves much faster, I believe that the $2 trillion a day of volume will eventually get to $50 trillion a day of volume. It's just like, an analogy is 50 years ago, if you said the number of posts that are going through a postal errand work are 100,000 a day, hypothetical, right? And if you introduce SMSs, it won't be 110,000 a day. It's actually 1 trillion a day, effectively. That level of, when we basically take money and make it programmatic and allow it to move 24/7, 365 at extremely low costs, that is going to be the effect of cross-border money movement. And we're also entering this world of AI, where money no longer can move at human timescales. And that is going to be a big differentiating factor. Money has to move programmatically. AI agents are not going to wait 3 days from sending from AI agent 1 to AI agent 2 and be like, let me wait for the money to receive. They're going to expect to send 1 trillion transactions of a few cents each every single day and ensure that the money gets to the other side very fast. And that has to happen through APIs. That has to happen programmatically. And that's infrastructure we're building, and that's how we differentiate ourselves.
Right. It's fascinating. You have the 24/7 deep liquidity on one hand. Then you mentioned the automation and making it programmatic so that no one needs to talk to the trading desk. So that enables a lot of scale. In this new model, what's the next thing to break? Where does this new bottleneck start to form in this new form of doing this cross-border FX?
Yeah. Candidly, where at scale things are already breaking and will continue to break for us is in two aspects. One is in banking. As much as we're trying to disrupt the existing infrastructure, we still have to rely on banks, right, to sort of move money across the world. As soon as anyone realizes you're using stablecoins, we're not a crypto company, we're not a Web3 company by any means, but just the mere fact that you're using stablecoins, sort of raises all sorts of red flags to banks, and they're like, we don't want to even look at you guys, right? And if we are having that trouble, right, imagine all the young companies are coming out of YC and saying we're a crypto native stablecoin player, et cetera, et cetera. It's just very painful for them, right? So banking in every shape and form, whether it's access, whether it's access to APIs, whether it's access to banks that actually work 24/7, whether it's infrastructure that doesn't break, sometimes money just doesn't reflect on banks. And why? Because some human is sitting in the back of the bank trying to credit every single thing. So as much as you automate things on your end, if there's a dependency on that bank to have a human being who's going to see that money and credit it, suddenly that is the last mile choking point there. So that is going to be a fundamental choking point in this industry and has been for us at this point. And second thing that we're going to face at scale is balance sheet, right? If we really want to solve this problem, and again, $2 trillion a day problem means probably need what? $500 billion, maybe $1 trillion of balance sheet. I'm good, but I'm not that good. I can't raise $1 trillion of capital, and that's the most inefficient way of doing this too. So, we have to figure out a very creative way to solve this problem. We have some ideas, and we're working towards it.
Yeah, and I think as we're getting, this has been a fascinating conversation. As we're coming close to the end here, maybe we could just break out into the future a little bit more. There's You've talked about how you're fundamentally rethinking like the FX space, leveraging stable coins, leveraging automation. Now things are just getting faster and faster and faster. But like, what does FX look like, I think in a long enough time horizon? And then also maybe break down, like, we're starting to see this like early emergence of non-USD stable coins also. Like, curious how you see like benefits for any of those as well.
Two different questions, so let's unpack them. Long enough time frame could be anything. I actually have my own worldview on where the world's going in about 30, 40 years. Let's not talk about that. Let's talk about 10-year time frame, more bounded. In 10 years, I have a high degree of confidence that the largest users of FX is not going to be anybody in this, sort of call over here. It's not going to be human beings. It's going to be AI agents. Everything that has been built in the last 30, 40, 50 years in the world of fintech has been built for human timescales, end of day batch processing. That's not the way the world FX world is going to be in the next 10 years. It's going to be AI agents who are going to do, like I said, 1 trillion transactions a day, or million transactions a day of $2 each, as opposed to 2 transactions of $1 million each, which is exactly how we work today. That's not the case. So we're building that infrastructure for that world, because we're already starting to see some of these fascinating use cases. It blows my mind when I see these young startups trying to build for new applications. We're like, I really don't know what's going to take off. It's like 2005 and you're building AWS and you see all these new startups. I have zero clue what's going to happen in the world, but it's fascinating to see all these use cases get built on OpenFX. Now, what's the second part of your question, right? Sorry. Stablecoins. So let's see. Is there an inherent advantage of regional stablecoins around the world? Yes and no. So now if you look at most of these emerging nations, they already have local RTP rails that allows them to move money 24/7, 365, right? India, Mexico, Brazil, all of the AED, PHP. What does a stablecoin in that currency allow them to do? Really nothing much. Like money, like you've been to India, I'm guessing, a bunch of times. Like if you use a UPI, there's no limits. It works better than stablecoins. Why do I need a stablecoin for INR? There's really no benefit. If anything, all of the last mile sort of like regional countries, the demand is for dollar-based stablecoins, because all of these countries have 10, 15, 20% inflation, and they don't want to basically sit on their local currencies. They want to sit on a dollar-denominated asset. It's very difficult for them to get access to dollar-based accounts. But having access to a dollar-based stablecoin allows them to sort of like escape the inflation costs and also get access to like higher yield generating abilities and all of that stuff. So that's where the demand is. The only use case that I can see of for regional stablecoins is creating like an on-chain FX world, and we touched upon this briefly, where if you have access to this, maybe the world is going to look very differently in terms of what it's going to look like. But so far, in the last 2 years of having operated OpenFX, we have pushed a lot of these regional stablecoins through our platform. We haven't seen much adoption and success from players because there's really no use case for it.
Yeah, this is always a hot topic, and I'm glad we touched upon it here. One of the things you started with was comparing to the regions that had already functional RTP rails. And it makes sense. And I think it's an argument that we've discussed on the show in the past, where for domestic use cases, if the payment is starting or ending in fiat and they already have local RTP rails that work, you're just going to go through the path of least resistance, particularly the path that already has network effect. But there are regions that do, heavy in trade that don't have RTP rails. And then there's a question of what does the government choose as its technology base? Does it go and create an RTP rail in its control, or does it decide to go to the new open blockchain path? Unseen so far. But I think that's one of the potential areas for non-US dollar stablecoins to take off, which touches upon the point you mentioned, which is where there isn't a good local RTP rail.
Aligned, fully aligned. And whether that becomes a CBDC or whether that becomes a stablecoin, yet to be seen. I've heard all different iterations from the regulators, the central bankers. It's a fascinating world that we're going to enter, like I said, in the next 10 years. Fun to watch it from here.
And maybe for another time we hear your 20 to 30 year vision. But we are at time here, so that will need to be another episode. Prabhakar, this has been Awesome. Learned a tremendous amount. Where can folks go to find out more about you and OpenFX?
Thank you. Thank you for having me here, Chuck and Raj. OpenFX.com is what our website is. If you want to find me, you can find me on LinkedIn. I'm on Prabhakar Reddy. OpenFX, you can look me up. I'm also on Twitter at Prabhakar2Reddy.
And you, Raj?
You can find me on X at rparekh and mana.xyz.
And for me, stablecoinblueprint.com, X Chuck_XYZ, and LinkedIn as well, Chuck Okpalugo. Thanks for coming on the show.
Thank you so much, Bill.
This was awesome. Thanks, Prabhakar.
Thanks so much for listening to Money Code. There was so much to take away from today's conversation. I learned a lot, and I hope you did too.
If you enjoyed this episode, do us a favor, share it with someone you know, or give us a 5-star rating on Apple, Spotify, or wherever you get your podcast from. Until next time.